there seems this sharp departure point, 1974.
Yes.
Was there a change in, were there innovations in the financial services industry? Were there regulatory changes? Were there cultural changes? Can we pinpoint any one thing or series of things that led to this? And then after that, what, if anything, we should do about it now that we have seen the problems with it?
Part of the problem, it seems pretty clear, looking back on this history, is that the banks were losing their historic corporate banking business to the money and capital markets. So their short-term loans became commercial paper issuance, where other parties, non-bank parties, were dealing directly, lending money to each other in the Similarly, the bond market took more and more financing away from banks. You had the growth of lower quality bonds, which might have been in a different day bank loans. Highest quality bonds would have always been bonds. Lower quality bonds could have been bank loans. So there was a taking away of certain historical business of the banks. You had the collapse of the savings and loans in the 1980s, real estate market, which I suppose opened up a space for real estate. So that part of the argument is that the banks lost this business, and they replaced it real estate exposure. I'm not sure, though, that I have a good theory for the whole phenomenon we're discussing. Part of it too has to do with deposit insurance. So banks get their hands on the public's money in the form of deposit insurance, guaranteed by the government. The banks themselves have to put up the deposit insurance fund, but the government actually guarantees the deposits, which means banks can always get their hands on it. And if being able to raise it, one of the things you can always do with it is make loans on real estate. Mm-hmm. So there is this moral hazard problem that we often talk about in the Fannie Mae and Freddie Mac world, where Fannie and Freddie's bonds and mortgage-backed securities were guaranteed by the government, but they could go ahead and take risk. And the bondholders weren't sharing in the risk because they're guaranteed by the government. Same is true in banking. The deposit holders aren't sharing in the risk. So there's a break between the risk that the suppliers of the money to the bank take, which isn't much risk if you're guaranteed, and the risks being taken on the other side by the bank. And anybody who is a theoretician of banking knows about this, and their answer is usually, well, we'll just regulate the banks so that this won't happen. They won't be overly risky, but that never works. In fact, we always have banking problems anyway.
And not only that, to the extent that this moral hazard here of severing the interest that depositors might have for making sure that their money will still be there, rather than question that out of the crisis, if anything, we're broadening that.
Absolutely.
The coverage. We're extending it to money market funds.
Yeah.
Is it your take that that's a good idea, the direction we should be going?
No, I don't think it's a good idea, but it's a truth. Your observation is true. We are increasing deposit insurance amounts, supposedly temporarily, probably permanently. And we should mention that the deposit insurance wasn't formally an obligation of the U.S. Treasury until the 1980s. The government tried to keep up the position. The deposit insurance corporations were actually insurance corporations. It's what the founders of deposit insurance thought should be the case. I'm speaking of Senator Glass and Congressman Stegall in the Banking Act of 1933. We're going to make the banks do this themselves. We're not going to have the government guarantee the liability. But when we got into the 1980s, and you had the savings and loans collapsing, and the commercial banks also in deep trouble in the 1980s, in fact, Congress then passed a resolution saying, oh, really, it's a Treasury guarantee, so that now, if you go into any bank, look at the teller window find the FDIC sticker, what does it say? It says backed by the full faith and credit of the United States government. And that's something that happened in the 1980s, this permanent expansion of the government's liability, which some people argued was always there, but it wasn't formally there. This crisis, now we go another 20 years, late 1980s, the real depths of the 80s collapse. 20 years later, as you so rightly say, we're getting another expansion of government support and an increase in moral hazard, which means you don't have to care about what someone is doing with your money because you're covered. And where does that go? Well, many people observing this point this out, but the short-term calming things down always takes precedence over thinking about long-term structures.
As we're sure that these financial booms and busts have happened in the past and they'll happen again in the future, we also, out of this bust, have had the predictable regulatory response, or I say it's predictable in the sense that we knew that there would be a response, a political response, even if the particulars may change depending on the bust in question. So let's just talk about some of the ideas that are floating out there and get your take on it. One is the idea for a consumer financial protection agency, which, as I understand it, you're not, while you can understand maybe the impulse behind it, think that there may be some problems with this idea. What are those?
That's correct. As you say, a prediction you can make with 100% probability is in the wake of the crisis, in the wake of the bust, there'll be a political regulatory reaction. Why? Because the politicians have to show that they're doing something, and they always say, we're going to put in a new bunch of regulations and controls so this will never happen again. And when it happens again, then we put in a new bunch of regulations to make sure it never happens again. So that's where we are right now in the political process. One of the ideas is this Consumer Protection Agency. My notion on it is that it has one really good idea embedded into it, accompanied by a lot of bad ideas. One good idea is clear, simple information to people who are borrowing money about the commitments they're really making. It is clear. Some people in the recent bubble knew exactly what they were doing. They were taking a lot of risk. They were buying a house they couldn't afford. And they were speculating that the price of that house was going to go up some more. Well, they'd been going up for 6, 7, 8 years. Why not another couple years? That's the root of the bubble. But other people, it seems clear, generally didn't understand what they were getting themselves into in the financial commitments they were making. So a really good idea is clear, straightforward. Some people call it disclosure. I think the better term is information. We want you to have key information about the commitment you are making, because that's the way you'll be able to exercise, in the best way, your personal responsibility. Decide how much risk you're willing to take and what you're getting yourself into. And that idea is in this Consumer Protection Agency, wrapped around with a lot of other ideas, which are less appealing. Secretary Geithner said at AEI a few weeks ago, the overwhelming activity of the Consumer Financial Protection Agency will be, he said, consumer disclosure, or what I call key information. Would that would be true if we ever get it. I doubt that it will. Because the other thing that if you create a new agency you will get, in my judgment, is a highly intrusive, very expensive, burdensome, not only for purveyors of financial services, but also consumers of them, a regulatory bureaucracy. Just imagine who would staff this new independent thing. And however they cloak it as being theoretically part of something else, the idea is to have this be a standalone, very powerful agency.